durable price stability can strong foundations be secured for high growth. The MPC remains committed to restoring the inflation growth balance. I repeat, the MPC remains committed to restoring the inflation growth balance in the overall interest of the economy. Accordingly, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting, and also to continue with the neutral stance of monetary policy, as it provides flexibility to monitor and assess the outlook on inflation and growth, and then go on to act appropriately. I would now like to provide an assessment of growth and inflation, and I would like to begin with the global growth scenario. The global economy has shown unusual resilience in 2024, despite several headwinds. Inflation is gradually moving towards the target from its multi-decadal highs, prompting several central banks to embark on policy pivots. Global trade remains resilient, with increasing volumes confined within geographical blocks. Since the last MPC meeting, financial markets have remained edgy amidst rising US dollar and hardening bond yields, resulting in large capital outflows from emerging markets and also in volatility in equity markets. Going forward, the outlook is clouded by rising tendencies of protectionism. I'm talking about the global economy. Going forward, the outlook is clouded by rising tendencies of protectionism, which have the potential to undermine global growth and also push inflation higher. Let me now turn to the domestic growth situation. Growth in real GDP in the second quarter of this year at 5.4% turned out to be much lower than anticipated. This decline in growth was caused mainly by a substantial deceleration in the industrial growth from 7.4% in the first quarter to 2.1% in the second quarter due to subdued performance of manufacturing companies, contraction in mining activity, and lower electricity demand. The weaknesses in the manufacturing sector, however, was not broad-based, but was limited to specific sectors such as petroleum products, iron and steel, and cement. Going forward, high-frequency indicators available so far suggest that the slowdown in domestic economic activity bottomed out in the second quarter of this year, and it has since recovered, aided by strong festive demand and pickup in rural activities. Agricultural growth is supported by healthy kharif crop production, higher reservoir levels, and better rabi sowing. Industrial activity is expected to normalize and recover from the lows of the previous quarter. The end of the monsoon season and the expected pickup in government capital expenditure may also provide some impetus to cement as well as iron and steel sectors. Mining and electricity are also expected to normalize post the monsoon-related disruptions. I specifically commented on these sectors, that is on manufacturing, on electricity, and also on mining and iron and steel, as well as on cement, because these were the sectors, particularly in manufacturing, mining, and electricity demand, which were the principal factors which pulled down the GDP number in second quarter. So that's why I have focused how these three sectors are expected to behave in the current quarter as well as in the next quarter. The Purchasing Managers Index, that is PMI for manufacturing at 56.5 for November, remained elevated. The supply chain pressures eased in October-November and fell below the historical average. The services sector continues to grow at a strong pace. PMI services remained steady at 58.4 in November, indicating continued expansion. On the demand side, rural demand is trending upwards, while urban demand shows some moderation on a high base. Government consumption is improving. Investment activity is also expected to improve. On the external front, merchandise exports expanded by 17.2% in October, while services exports continued to post upbeat growth at 22.3% in October. Taking all these factors into consideration, real GDP growth for 2024-25, that is the current year, is now projected at 6.6%, with Q3 at 6.8% and Q4 at 7.2%. Real GDP growth for the first quarter of 25-26 is projected at 6.9% and the second quarter of 25-26 at 7.3%. The risks are evenly balanced. I would now like to focus on inflation. Inflation increased sharply in September and October 2024, led by an unanticipated increase in food prices. Core inflation, though at subdued levels, also registered a pickup in October. Fuel group remained in deflation for the 14th consecutive month in October. In the near term, despite some softening, lingering food price pressures are likely to keep headline inflation elevated in the third quarter, that is, in the quarter October to December. Going ahead, a good Rabi season would be critical to the softening of food inflation pressures. Early indications point to adequate soil moisture content and reservoir levels, conducive for Rabi sowing. The estimates of record Kharif production should bring relief to elevated prices of rice and tur dal in particular. Vegetable prices are also expected to see a seasonal winter correction. On the upside, the evolving trajectory of domestic edible oil prices following the hike in import duties and rise in their global prices need to be monitored closely. Manufacturing and services firms surveyed by the Reserve Bank point to firming up of input costs and selling prices in the fourth quarter of the current financial year, that is in the quarter January to March. Taking all these factors into consideration, CPI inflation for the current financial year, that is 24-25, is projected at 4.8%, with Q3 at 5.7%, Q4 at 4.5%. Going into the next financial year, CPI inflation for the first quarter of 25-26 is projected at 4.6% and Q2 at 4%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? I have described the growth conditions. I have described the inflation conditions. Now, what do all these factors mean for monetary policy? And that is what I would like to now highlight. The near-term inflation and growth outcomes in India have turned somewhat adverse since the last monetary policy in October. The medium-term prognosis on inflation suggests further alignment with the target, while growth is expected to pick up its momentum. Persistent high inflation reduces the purchasing power of consumers and adversely affects both consumption and investment demand. The overall implication of these factors for growth is negative. Therefore, price stability is essential for sustained growth. On the other hand, a growth slowdown, if it lingers beyond a point, may need policy support. The Reserve Bank's anti-inflationary monetary policy stance has been a crucial factor in bringing about a significant disinflation. Going forward, as food price shocks wane. Headline inflation is expected to ease and realign with the target as per our projections, which I just read out. At present, it is necessary to draw on the flexibility provided by the neutral stance of monetary policy to wait for and monitor the incoming data for confirmation of the decline in inflation. The gains achieved so far in the broad direction of disinflation, notwithstanding the recent upticks, need to be preserved. At the same time, the growth trajectory and the evolving outlook also need to be monitored very closely. At this critical juncture, prudence and practicality demand that we remain careful and sensitive to the dynamically evolving situation with all its complexities and ramifications. A status quo in monetary policy in this meeting of the MPC has thus become appropriate and essential. I would now like to turn to liquidity and financial market conditions. System liquidity, as represented by the net position under the LAF, that is net LAF, that is net liquidity adjustment facility, it continued to remain in surplus during October and November on account of higher government spending, despite a significant increase in currency in circulation during the festive season and capital flows. Of course, towards the end of November, for a few days, the liquidity became tight, but overall, I think there was adequate liquidity both in October and November, and it remained in surplus. Given these conditions, the Reserve Bank mainly conducted variable rate reverse repo operations, that is VRRR operations, to absorb surplus liquidity. To alleviate temporary liquidity tightness because of large GST outflows, however, fine-tuning variable rate repo operations, that is VRR operations, were conducted intermittently during October and November. The two-way liquidity operations of the Reserve Bank ensured close alignment of the interbank overnight rate with the policy repo rate. Transmission to the credit market has been satisfactory. As you would have noticed, as in the previous monetary policy statements, lot of data is given in the footnotes. So those of you who are interested may have a look at the footnotes, because the data in the footnotes justify and back up whatever I am saying as a part of my statement. Now, even as liquidity in the banking system remains adequate, system liquidity may tighten in the economic and financial landscape created by geopolitical conflicts, geoeconomic fragmentation, financial market volatility, and continuing uncertainties, all of which are testing the resilience of the global economy. The last mile of disinflation is turning out to be prolonged and arduous, both for the advanced economies as well as the emerging market economies, that is the EMEs. Maintaining macroeconomic and financial stability and building buffers continue to be the lodestar, especially for the emerging market economies. In India, notwithstanding the recent aberration in growth and inflation trajectories, the economy continues its journey on a sustained and balanced path towards progress. Amidst the reshaping of the global economy, India is well positioned to benefit from the emerging trends as it forges ahead on a transformative journey. Let me now turn to the decisions and deliberations of the Monetary Policy Committee, which met on 4th, 5th, and today 6th December. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook, the Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%. The MPC also decided unanimously to continue with the neutral stance and to remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. I shall now briefly set out the rationale for these decisions. The MPC took note of the recent slowdown in the growth momentum, which translates into a downward revision in the growth forecast for the current year. Going forward into the second half of this year and the next year, the MPC assessed the growth outlook to be resilient, but warranting close monitoring. Inflation, on the other hand, surged above the upper tolerance band of 6% in October, driven by a sharp uptick in food inflation. Food inflation pressures are likely to linger in Q3 of the current financial year and start easing only from the Q4 of the current financial year, that is from January to March. And we expect that this is the trend and it will be backed by seasonal correction in vegetables prices, Kharif harvest arrivals, likely good Rabi output and adequate cereal buffer stocks. High inflation reduces the disposable income in the hands of consumers and dents private consumption, which negatively impacts the real GDP growth. The increasing incidence of adverse weather events, heightened geopolitical uncertainties, and financial market volatility pose upside risks to inflation. The MPC believes that only with durable price stability can strong foundations be secured for high growth. The MPC remains committed to restoring the inflation growth balance. I repeat, the MPC remains committed to restoring the inflation growth balance in the overall interest of the economy. Accordingly, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting and also to continue with the neutral stance of monetary policy as it provides flexibility to monitor and assess the outlook on inflation and growth and then go on to act appropriately. I would now like to provide an assessment of growth and inflation, and I would like to begin with the global growth scenario. The global economy has shown unusual resilience in 2024 despite several headwinds. Inflation is gradually moving towards the target from its multi-decadal highs, prompting several central banks to embark on policy pivots. Global trade remains resilient, with increasing volumes confined within geographical blocks. Since the last MPC meeting, financial markets have remained edgy amidst rising US dollar and hardening bond yields, resulting in large capital outflows from emerging markets and also in volatility in equity markets. Going forward, the outlook is clouded by rising tendencies of protectionism. I'm talking about the global economy. Going forward, the outlook is clouded by rising tendencies of protectionism, which have the potential to undermine global growth and also push inflation higher. Let me now turn to the domestic growth situation. Growth in real GDP in the second quarter of this year at 5.4% turned out to be much lower than anticipated. This decline in growth was caused mainly by a substantial deceleration in the industrial growth from 7.4% in the first quarter to 2.1% in the second quarter due to subdued performance. நாடு முழுவதும்